Hey everyone, in today's video I'll explain what a fair value gap is and why it's important in trading. Whether you're new to trading or just want to get a better understanding of market structure, this video has you covered. What is a FVG? A fair value gap is a concept in technical analysis that highlights imbalances in the market. It occurs when there's a visible gap between three consecutive candlesticks, often due to a strong one-sided movement. These gaps are important because they represent areas where the market didn't fully trade, leaving an imbalance of orders. How is a FVG created? Imagine these three candlesticks, or these. When the market moves too quickly in one direction, the wick of the first candle doesn't overlap with the wick of the third candle, so this wick doesn't overlap with the last wick of these three candles. The second candle in between creates this imbalance, leaving a gap where the price didn't trade. This gap is what we call a fair value gap. How to spot a fair value gap? Spotting a fair value gap is simple once you know what you're looking for. First, focus on the three consecutive candlesticks on the chart. These three. The key characteristics of an FVG is there's no overlap between the wick of the first candle and the wick of the third candle. This creates a gap in price, typically caused by a strong and quick market move. This big move here. This is also called a displacement. If you look closely, you can also see there's also a fair value gap right here, from this wick to this wick, and there's also a very small fair value gap from this wick to this wick. Most of the time, a big displacement like this has multiple fair value gaps in it. Now we know how a fair value gap looks, but why does it form? Fair value gaps occur because the market moves too quickly in one direction. This typically happens during a strong one-sided move, which is also referred as a displacement. Now, how to trade a fair value gap? To trade a fair value gap effectively, you can combine it with key market structure concepts to increase the probability of success. This approach is based on the ICT 2022 model. Let's break it down into three simple steps. The first step is to identify a liquidity sweep. This happens when the market takes out stop losses or key levels like highs or lows, creating a sudden spike in price. Now, the second thing you have to look out for is a market structure shift. After the liquidity sweep, watch for the market structure shift. This is when the market breaks a key structure, signaling a potential change in direction. When you get the market structure shift, it's also very important that it has displacement behind it, that it has big volume, it's a big move. Now, for the final step of the ICT 2022 model, you're going to enter on the FVG created by the displacement. Now I'm going to hop on the charts and show you guys how it looks. In this scenario right here, you got the high with a lot of liquidity above this high. What you are then looking for is a move up towards the high, and you want to wait for it to hit your liquidity point. Once your liquidity point is hit, you want to wait for displacement with market structure shift. This right here is the market structure shift. Now, almost every single time, there's going to be a fair value gap right here, around this area. And that's where you're going to take your entry and wait for price to come into the fair value gap and then go further down. And this model right here, the ICT 2022 model, is the foundation for all my strategies that I use to make profits in the market. Now for some examples on the chart. We have this recent high right here as our liquidity point. And now we're just going to wait for it to get swept, and then market structure shift, displacement, and fair value gap. So let's wait for that. Right there, it hit the liquidity point. No displacement yet. And there we got displacement. This is a big move indicating that the market wants to go down. At the same time, we got a market structure shift right here and right here. So that's just even more confirmation. And we got a fair value gap right here, connecting this wick right here to this wick right here. So we got everything we need. Now we're just gonna set a limit on the fair value gap, stop at the high. It can be a good idea to put the stop loss a bit above the high so you don't get wigged out and then it goes into take profit. That's annoying. And then target at 1 to 2. And let's see. We got into the trade. Pretty good immediate reaction here. Back up to entry. But we eventually got the take profit. We got another example here. This is the recent high. I'm gonna mark that out. And then we're gonna wait for a liquidity sweep. And we got that right there. Now we're just waiting for a market structure shift with displacement. And we got that. So we have the market structure shift right here. And we also got a fair value gap right here. So now I'm just gonna put my entry here, stop loss at the high, and then target 1 to 2. Entered into the trade and hit our take profit. Right here we are in a downtrend, so I will be marking out the recent high and wait for the sweep. We got the sweep. Now we want to see a market structure shift with this low, and we got that right there, plus the displacement as well. Now we're just going to look for the FVG, which is right here, and place our entry right there and target 1 to 2. Got tapped into the trade and immediately to take profit.